So I'd like to welcome you this morning to our 2024 Retail Forecast Report. I'm delighted that today we're again joined by Dean from UBS to help develop our insights into, one, what's happened in 2023, but also what we're seeing as key themes as we move into 2024. A focus of the report this year for us has been that ever increasingly important consumer of the Gen Z, and we'll be deep diving into that as part of our review, but also as we finish what again was a challenging year on the back of a number of challenging years. I particularly am quite interested to hear some of the thoughts out there as to what are going to be those key themes as we take and step forward into 2024. Please, if you've got any questions, we will be having a Q&A session at the end of the webinar this morning. So do post those into the Q&A at the bottom of your screen. And with that, I'm delighted to pass over to Sophie Michael, who's going to take us through the first session.
Thanks, Laura, and morning, everyone. As Laura said, and as no doubt expecting us to say otherwise, last year was a very challenging year. At this moment, the key word to every business, and actually whichever sector it sits in, but also for the consumer alike, is inflation, where we have seen the most significant hike to the cost of living for more than 30 years. For most consumers, therefore, this has been the highest price movements they have ever experienced. And for retailers, they've had a double blow. It's not only a heavy challenge for higher operating costs for retailers, but also for their consumers, their key source of revenue. The consumers are finding a greater slice of their spend is required for that essential spend, leaving less for discretionary spend. We can point to the many causes of this, whether it's the pandemic, geopolitical matters, or our own UK economic policies here, but these factors have all led to stubbornly high inflation last year, and therefore higher operating costs, but also a more cautious shopper. More recently, we've also seen the reoccurrence of disruptions to supply chains and freight costs once more on the rise. So inflation has squeezed household budgets, creating further pressure on disposable income. Those savings that were created in lockdown are believed to have been largely spent, and high interest rates have deterred shoppers from using credit to fund purchases. This has all led to a much more cautious consumer as we headed into Christmas last year. So not a rosy start, but I promise that we will also look at opportunities that lie ahead. Consumers will continue to spend and there will always be winners. It's about how to be in that winning pool. So this morning, next slide, please. This morning, I'm going to quickly move through the past year, moving on to how Christmas fared and then onto some of the key themes and areas. But before I start, I just wanted to put one thought in our minds. Retail forever seems to be putting out short-term fires. When back in our minds, we all know that to grow a sustainable business, we need to invest. With technology and the fast pace of change, this is even more important to enable any business to build those foundations for the longer term. That's why selecting what you do has never been more critical, but at the same time, selecting what you put to one side, especially when working capital is constrained. So this slide shows that in 2023, the UK narrowly avoided a recession. There was low to no growth with the UK's GDP at 0.5%, versus the previous year of 4.3%. Whilst the economic picture won't revert to the same growth that we saw in earlier years, it is providing more positive reading. Next slide. The UK market grew by 4.3% in 2023, but with inflation at 9.5%, that meant that volumes came down by over 5%. Growth is expected to slow in 2024, but as inflation eases, purchase volumes will not fall by the same pace, although purchase volumes are not expected to rise until 2025. This prolonged recovery period highlights the lingering influence of high inflation on consumer spending habits, and it indicates that real need that retailers need to remain cautious with their projections in the year that we're in. Next slide. We all know that consumer confidence is critical to retail spend. Although consumer sentiment has been gradually rising throughout 2023, it still remains firmly negative. It also still remains weaker on average than pre-pandemic. Many of the challenges that consumers faced in 22 also continued in last year. The graph on the right is the average consumer sentiment going back to 2014, which reflects how vastly low it's been compared to those pre-referendum years. With consumer sentiment so negative, retailers have had to work so much harder to get consumers to spend on non-essential goods. Next slide. This chart shows real wage growth by showing UK consumer price inflation against average weekly earnings. In April this year, the growth in average weekly earnings surpassed inflation growth, signifying a positive shift in the UK economy. Although both rates slowed during the latter half, real wage growth has been maintained. There are plans that the national living wage will rise from 2024, which will give a further boost to consumer spending power. But at the same time, this also adds to the costs of retailers. And now many of the larger retailers are saying that the biggest driver behind inflation is wage cost. Next slide. This is our high street sales tracker, which tracks weekly spend for non-essential items across three categories: fashion, homeware, and lifestyle. For each of these categories, we also track the spend separately between bricks and mortar and online, and provide a combined total spend across all channels. This chart shows that total spend. Ongoing high inflation, particularly for essentials like food and energy, has continued to squeeze household budgets. Essential spend taking a far greater proportion of consumer purse and leaving less for that discretionary spend. Not only was discretionary spend less, but actually we've seen so much more of a competition from leisure and hospitality. People have been spending on fun and not so much on things. And yesterday we saw those record subscription figures from Netflix as well. Our high street sales tracker showed that retail sales growth lagged behind 2022 in every month apart from August. And when you take into account inflation, volumes have been down every single month. Next slide. So looking at online itself, which I think is also interesting, is that pre-pandemic, we were seeing growth rates of between 5 to 25% on a like-for-like basis, showing that ongoing shift of consumer shopping behaviours from bricks and mortar to online. Online spiked during the pandemic, as we expected, because it was very often the only channel available. But last year was the first year that we had some proper benchmarking, and online slowed. And in many months, it was even flat and in some negative. So why is this? Next slide. Consumers appeared to be returning to bricks and mortar, and three reasons have been cited for this. First, following lockdowns, it's simply because of the enjoyment factor of physical shopping rather than from an armchair. The second, which is probably the key reason, is to avoid those delivery costs and return costs that retailers are being forced to charge because of the cost of online and the consumer being impacted by the cost of living crisis. And the third, because when the purse is tight, people take a much longer time to actually make that purchase decision, and they want to touch and feel that product. When you break it down by category, clothing and footwear was the fastest growing category in 2023. Consumers believed to be buying for the strong holiday and socialising calendars. But again, when you look at inflation at 1.4% growth only, volumes were down. Home categories saw the largest decline, And again, people are not spending on those larger ticket items. From 2024, we expect that online will return to growth in the overall retail market, and with advancements in technology such as AI, enhancing that online experience and the shopping journey. However, this does require investment, and those businesses that can invest will benefit from these drivers, but many won't have the funds, and that gap is widening. Next slide. When we look at Black Friday, Cyber Monday, it was flat at 0.4% overall. While Black Friday weekend spend declined against stronger comparatives last year, spend on Cyber Monday bounced back, showing that consumers were really waiting until that last minute to ensure they got the good deals. Electricals and clothing and footwear were once again the most popular categories over Black Friday, where discounts drive the sale of higher than wanted inventory levels by fashion retailers, and where to drive sales of electrical, discounts are required due to the availability of price comparisons. However, what was really notable this year was that Black Friday started very early, and for many retailers, it actually started with what's termed Singles Day, which came over from China, 11th of November. Again, Black Friday week itself stretched over the whole week as retailers made every effort to convert their stock into cash, knowing that spend was limited. It's going to be really interesting to see what these discounts have done to margins and profits, because as usual, all we've heard so far is the like-for-likes on top line. Next slide. This graph shows our high street sales tracker for each December for the past 7 years. The block chart is online only like-for-like for the month of December, and the blue line is total for each December. And for me, this is quite a stark picture. Our tracking of total sales goes back circa 15 years. Our tracking of online as a separate channel goes back to 2017. And this shows that like-for-likes for discretionary spend was only ever negative this past December, apart from, of course, the COVID year. When you take into account inflation, volumes have really fallen this past Christmas. Now, this is discretionary spend across fashion, home and lifestyle. And in contrast, there's been many reports of the strong grocery sales. Some reported that consumers plan their purchases ahead of time for Christmas, which led to this decline in December. However, every month of that golden quarter, October through to December, for discretionary spend retailers was actually negative. And this is the first time that we've seen that. The decrease in December spending was mainly driven by poor performance in in-store purchases. However, whilst online perhaps performed better in December, it was still only marginal at 0.6%. And that compared to the heavy postal strikes that we had last year. So it's really understanding and unpicking these numbers, which is important. And this is a real concern to retailers who rely so heavily on that golden quarter. Next slide. There are lots of reports, as I say, in terms of Christmas trading. And this report gives a breakdown of some of those relative festive categories. The spending grew at a lower rate of just 0.9% in 2023, with consumers looking to save wherever they could. Just as an example, spending on decorations was hardest hit by being down by 20%, where consumers chose to reuse what they had. But you can also see the tough comparatives to holiday and travel, which had a strong positive. In summary, the UK retail sector experienced its worst December for discretionary spend, with like-for-likes down by 2.7%, according to our high street sales tracker. Next slide. When we look at some of the winning and losing themes over Christmas, for grocers, it's been widely reported that supermarkets have performed well over Christmas, and consumers channeled their spending to the Christmas table rather than buying gifts. Britons broke records with supermarket shopping in the Christmas week alone at 4.3% higher than the year before, and volumes were also up by 1.2%. Food sales reported 8.1% higher for the 4 weeks leading to Christmas, whereas non-food reported only 0.1%, a big contrast. All major grocers in the UK have reported strong results during Christmas, but interestingly, the grocery market, the increased price competitiveness of the traditional big four has shown signs of success, as the discounters of Aldi and Lidl have not dominated this Christmas period. M&S specifically turned its fortunes around by its ongoing focus on affordability and emerged as the top performing grocer in the run-up to Christmas. Their growth of 14.2% on UK grocery was more than the combined growth of Aldi and Lidl, who together rose by 14.1%. And the M&S group beat its competitors on volume growth every month in that final quarter, which is great to see. It's an impressive performance. But what's really interesting is that M&S focused on less discounting. And as they went into the January sale, they spoke about keeping it tighter and shorter, thereby protecting their margins. The frenzy of deep discounting is only going to end if more retailers can make a stand against it. Tesco's, again, smarter loyalty schemes, which we'll talk about later, also helped retailers such as Tesco's, who focused on elevating that long-established club card scheme and improving its product. And whilst M&S outperformed the discounters, nevertheless, Aldi and Lidl reported record trading. They both saw an increase in the number of shoppers, and Aldi now has 9.6% of the supermarket sector. Health and beauty. Last year, we forecast that health and beauty would be the best performing non-food sector in the golden quarter, and Superdrugs and Boots' performance for its quarter to the end of November demonstrated that resilience. Beauty items are an easy but affordable gift and treat, making the sector attractive when spend is restricted. But interestingly, also, both retailers have invested in their store estate, and they've benefited from having that accessibility of their locations as shoppers once again favoured physical stores. Additionally, those loyalty schemes have been at the forefront, with members' pricing being clearly communicated, appealing to shoppers seeking value for money and discounts. And online, whilst it had a difficult throughout 2023, it was more popular for Christmas shopping. And those pure plays such as Ocado, The Very Group and Marks Electrical had reported good results. There was a significant rise in online sales the week building up to Christmas, although, again, as I say, it was against weak comparatives, despite the overall growth. On the losing side, high inflation and increasing interest rates throughout 2023 hit the home improvement sector, and the stagnant housing market also didn't help. We saw Top Tiles sales decline by 7.1% for the 3 months to December, and even Dunelm with a muted growth of 0.1%, and we've come to expect that as that rapidly growing retailer. Their lower price products did well, but their high ticket furniture categories lagged behind. Sportswear, warmer weather during Christmas period has been blamed for lower demand for autumn and winter ranges. And retailers that we've again become accustomed to show growth, such as JD Sports, had like-for-like sales growth of only 1.8% in its second half. This is a significant slowdown from H1, and also other sporting retailers have reported disappointing results, with even Nike, albeit okay for Christmas, but announcing that it only had 0.5% for Q2. However, we do expect that going forward, the global sportswear market will still outperform total apparel. And luxury retailers have reported weaker results during the Christmas period, constrained by household budgets, have impacted those higher ticket purchases. Both Mulberry and Burberry have put slowdown as a result of the challenging macro situation, but also the lack of tax VAT-free shopping, which we've spoken about making the UK uncompetitive. Consumers focused their spending on essential items and traded down to cheaper alternatives where possible. In addition to Mulberry and Burberry, watches of Switzerland and Rolex also reported poorer performances. See from the slide those individual winners and those poorer performances by brand, which we've spoken about. And one other, Ocado, perhaps doing also better from its M&S, but also higher selling prices. Outside the grocers also, Next upped its profit forecast for the 5th time in 8 months, following a better than anticipated full price in November and December. And I think what's really interesting in M&S and Next is that both have invested heavily in their systems and online offering. Hence why it's likely that we're going to be seeing the gap widening between those retailers that are able to invest and those that simply do not have the funds. Next slide. Looking forward, the retail market is expected to return to growth in 2024, but at a slower rate than last year as inflation eases. With lower inflation, as I said earlier, we should see that the fall in volume will slow in terms of that fall. Consumers, however, are going to remain cautious, especially when it comes to discretionary spend. Next slide. Looking at it by category, the black bars show purchase volumes driven by inflation and the blue bar by volume. Most of the growth for most categories will continue to come from inflation. And this chart shows that the category most driven by volume for this year will be electricals, but it had a very sluggish performance for this past year. And there will be a replacement factor by consumers as well. Next slide. The graph following 4 turbulent years, this graph really shows the stark reality of inflation. And we're going to be hoping for a more settled year this year. We did see last week that inflation slightly rose, but when you unpick that number, there's very specific items, namely alcohol and tobacco. The markets still expect the Bank of England to cut interest rates, although maybe not as much as they previously felt. One of the more concerning factors, though, which is making more noise, is the cost of freight. And whilst we saw container shipping costs stabilise in 2023 and back to below $2,000 pre-pandemic levels, since the end of December, rates have risen fast. From over the course of 2020, just 10 days from 22nd of December, we saw them rise from under $16,000 in 2020 to over 4,000, and by mid-January they were over 5,000. We all know the causes of this, and that additional 7 to 10 days of sailing each way will have a drastic effect on supply. The question is, how long is this going to last? Longer terms, there have been plans to provide further capacity, but for the short to medium term, there's certainly challenges on this factor. Next slide. Although inflation is set to fall to its fastest level for 2 years, it's going to take some time to materialise into better profit margins for retailers and for consumer confidence to stabilise. 2023 was the first year since the pandemic that we began to see more normalised growth in both online and offline channels. The online channel returned to growth, although marginally. This is nowhere near those growth rates that we saw pre-pandemic. But we are expecting the online channel will outperform the overall retail market from this year. Next slide. When we break it down by category, the food and grocery market grew by 8.3% in 23, driven by persistently high food inflation. But even at this level, which is the highest out of all the categories, volumes fell. Rising prices have led consumers to trade down for their food purchases, and 4 out of 10 consumers said that they switched to cheaper products from their usual grocer, whilst over 12% are switching to cheaper retailers. Looking ahead, this year, the grocery market is expected to grow by 3.4%, with volumes forecast to remain negative in Q1. Health and beauty, this is expected to grow by 5.5% this compared to last year. And the essential nature of these categories force consumers to either endure the higher prices, but many again switch into lower price and alternative brands. DIY, it was flat in 2023 at 0.5% negative. So after a tough year when we had poor weather last year and a tough summer, not only was the cost of living weighing heavily, but also weather. So we are expected to see a growth this year, but it's against poor comparatives. Next slide, please. Electricals, the electrical sector declined last year, and it's expected to outperform from 2024 onwards, with rapidly growing retailers such as Marks Electrical boosting the market. Homewares spend rose last year, with the sector holding up well due to the essential nature of some items, but again, those bigger ticket items not performing so well. And clothing and footwear, like we said earlier, did grow, bolstered though by perhaps consumers using those saved savings. Spend on clothing and footwear slowed in the latter part of last year as those savings began to dwindle. And the Christmas period also went up against tough comparatives to the prior year. Next slide, please. Before we consider the key trends and themes for 2024, I just wanted to bring out a key area from our retail forecast report, which Laura mentioned as well. In this challenging market, retailers need to seek out those opportunities. And I appreciate that this will relate to retailers to different extents, but this is the presence of Gen Z and their growing importance to retail. Naturally, as the years go past, they will become more important as their spend increases, but are retailers equipped for their vastly different shopping behaviours? As retailers, are they actually capturing this purse today and ensuring that they're making the upfront investment to benefit from the future? Next slide, please. Gen Z, which are born between 1997 and 2012, now they're around 1 in 5 people in the UK. And whilst still some are in college and school, many have already entered the workforce. And they're collectively spending billions within the retail industry. The group is also relatively protected from the cost of living, not having mortgages. They're very trend driven. They show a greater willingness to spend on the latest products, and they look for brands that fit with their values and needs. They're also what I would call a much more informed shopper, weighing up their options before committing to a purchase. And this can bring a big challenge to retailers because they don't have much stickiness to brands or retails. They switch very easily. The themes that we're focusing on are all related to Gen Z. They stay on top of the latest brands and they meet the expectations when it comes to technology and social media. And they also need to focus on persuasive incentives and loyalty schemes, and of course the ESG agenda. These are the things that I believe all retailers need to focus on. And we've identified them as the top ones for 2024 and going forward. They're all very relevant to Gen Z. The first key theme being technology. Retail businesses must continue to innovate, leveraging new technologies and creating efficiencies across their supply chain, improving the customer shopping journey and boosting profitability. This is essential not only to provide experience, but remain competitive on pricing through these efficiencies. In this section, we're going to focus on retailers are using AI and the metaverse in particular to achieve these aims. Next slide, please. Artificial intelligence, or AI, can be used to boost profitability through many different routes. While AI is used by many to engage the shopper and improve the shopping experience, and therefore conversion across both digital and physical channels, many are using AI to reduce costs and also boost profitability. For example, using AI to reduce return rates, which is becoming an increasing cost burden to many retailers, can be done through improving sizing and product recommendations. If we took another example, being pricing, many retailers are now using automated pricing on fresh produce, potentially replacing what's now become known as yellow stickers. An AI system which was trialled in Europe has been rolled out with electronic labelling on shelving. This is expected to not only reduce costs further, but at the same time, it actually increases their profits by 30%. All of the major retailers, grocers have trialled this, and it's become known as those electronic shelf labels. Retail experts believe that this ESL is the first step towards digital labelling and a dynamic pricing model, reducing costs, but also waste. They could allow for retail updates throughout the day, and they benefit both the retailers, but also it's expected to reduce approximately 300,000 tonnes of food waste, which we generate in the UK each year. So immediately we can see the benefit of this, not only to retailers, but also how the consumer will find this of interest. Next slide. AI is also this shift from what's become known as a much personal service to the consumer to hyper-personalisation. Traditional methods use historical data to offer these tailored experiences, while hyper-personalisation uses real-time data. Consumers, especially Gen Z, demand this high level of a tailored service during their shopping journey. And it's gaining real traction in the health and beauty sector, with many retailer brands offering virtual try-ons for makeup, hair dye, and glasses. For example, Warpaint now offer an interactive shade finder on its website and has collaborated to offer a real personalised skincare service in its stores. We also saw Charlotte Tilbury launch a mobile app powered by AI to offer consumers tailored personal beauty solutions. And its technology also enables consumers to scan and analyse their skin type and recommend skincare routines. So you can immediately see how they engage and try to find that stickiness with their Gen Z consumers. Next slide, please. The big question, though, when cash flows are tight, is when and how much should retailers be investing in these areas? And when working capital is so tight? Generative AI, such as ChatGPT, can improve customer service with virtual shopping assistants and chatbots. These AI-powered bots respond promptly to questions about product availability and returns. And for example, Zalando is a good example where these ChatGPT-powered virtual assistants have been introduced. However, while many retailers that now have these facilities for their customers, there's still some way to go to boost uptake by the customer. And many customers remain skeptical. According to a recent survey, you can see that more than half said they're unlikely to use a chat bot to answer a question. Next slide, please. With the metaverse, the big question by many is, what actually is this? The metaverse allows retailers to create a virtual shopping environment that aids brand building through unique experiences. And this can provide a range of benefits. It can foster brand loyalty as consumers can shop in very personalized environments. But even more importantly, actually, and as we've seen, it gives retailers another platform from where they can collect data. Nike is a great example of this, and they allow their customers to design shoes in their metaverse using an infinite set of combinations. But what they get out of this is that they're enabled to identify emerging trends for different demographics and manufacture designs which can then be purchased in the real world. But there's of course a very high cost to this. And again, it's a question of choices. Despite big brands like Nike using the metaverse, consumer uptake and engagement is still low. And according to a recent survey, over half of consumers are aware of the metaverse, but only 1 in 3 stated that they would make a purchase. I actually spoke to many of our Gen Z in our own workforce over the coming weeks, and I found very few. So that statistic actually surprised me. The main driver of consumers not wanting to purchase in this metaverse, though, is not really understanding it. And 4 out of 10 cited this as a reason. In addition, these almost 4 out of 10 would never purchase that said they wouldn't purchase in the metaverse, said it's because actually they prefer to try on products. So it really renders one of these questions that is the metaverse obsolete? And why are retailers still investing in it? But many retailers want to have a metaverse strategy so that they can press play when the consumer sentiment changes. But in reality, for most retailers, they're in very early stage. And many believe that we're probably still 5 to 10 years away from mass adoption, which is a long time in the life of retail. Next slide, please. The next key theme is modern media consumption, and social media is becoming an increasingly important part of the shopping journey, especially among younger shoppers. Many consumers now use platforms such as TikTok and Instagram for product discovery and to browse, purchase, and review items. Although this provides opportunities for retailers and brands to boost awareness and engage with shoppers, it's also difficult to cut through all of that noise and stand out. Next slide, please. This chart shows that an increasing percentage of consumers were influenced by social media during their last in-store and online purchases in November 2023 compared to the same month last year. Not surprisingly, Gen Z are the main driver of this, and their use of social media is the most sophisticated of all prior generations. This will impact social media advertising, which is propped up by influencer culture. But I think it's really interesting how this influencer culture has also really changed. Moving into 2024, Gen Z will continue to disrupt the influencer sphere through their quest for authenticity, shown by the popularity of Be Real and the buzz around de-influencing. These trends have led to what this year is termed as micro-influencers, those that have between 10 to 50,000 followers, and nano-influencers, those that have less than 10,000. And it's these influencers, although having a smaller following, are perceived to be more authentic and are going to have far more higher engaged audiences. Next slide, please. Some retailers are starting to move away from sponsored posts on social media, as these sometimes come across as inauthentic to consumers and are finding other ways to engage with their shoppers. For example, activewear brand Tala uses a mix of inclusive affiliate influencers and user-generated content to really engage with their customers on Instagram. And many retailers are also introducing curated content on their own websites. For example, Zalando recently introduced stories, which highlights inspirational style content, new trends, and exclusive brand collaborations. Next slide. The third theme is loyalty and subscription programs. And in a world where consumers are exposed to countless options through social media, it's challenging to win new shoppers and even more challenging to get them returning. Consumer choice is now broader than ever. And with shoppers easily able to compare products and prices across channels and switch based on their preferences, most retailers now offer some form of member program to boost loyalty. Next slide. This chart shows the aspects of supermarket loyalty schemes that shoppers value the most. And schemes that offer discounts for members, such as club card prices and nectar prices, tend to resonate particularly well, as these offer an immediate and tangible price saving. Consumers also value programs that offer money-saving options for future purchases, such as points or cashback. A recent article reported that over 80% of people hold at least one card, and a fifth of those were members of 4 or 5 programs, while 14% held more than 6. However, the CMA is concerned about the impact of loyalty card pricing on competition, particularly in the supermarket sector. And they are expected to look at whether the schemes make it harder for shoppers to compare supermarkets to spot the best prices, given this 2-tier pricing system for members and non-members. Next slide, please. This chart also shows consumer agreement and disagreement with various sentiments about supermarket loyalty schemes. And these results imply that a loyalty scheme for a supermarket today is almost a given. Food and grocery retailers cannot therefore just rely on these schemes alone. And almost 70% of consumers use multiple different loyalty schemes. 80% of shoppers shop where prices are low. So supermarkets must therefore offer competitive prices to retain shoppers. Next slide, please. Health and beauty has been another popular area for loyalty schemes, with 44% of consumers already subscribed to one in this category. Boots has been the most successful in this space. And as the chart shows, they've got substantial lead on any other retailer, even Superdrug. In contrast to what consumers value within supermarket loyalty, health and beauty find the ability to collect points more appealing than exclusive discounts. And this could be actually quite problematic for Boots because they've been cutting down points in favour of discounted products. So loyalty memberships can play a big role in promoting retailers. And we saw that during the Black Friday week, where Superdrug rolled out early Black Friday promotions for its health and beauty card members. But this also shows that how important it is to find which scheme actually works best. Next slide, please. In the past, retailers and brands have successfully used subscription services, and we've seen this dwindle over the past couple of years with the cost of living crisis. However, subscription models can still play an important part. And for instance, Sephora offers a beauty box subscription service, which allows shoppers to select 5 new product samples that they want to try each month. So it's really finding what appeals in the sector that you sit in and the brand you're in. Next slide, please. The final theme, and possibly one of the most important, is ESG. Environmental, social, and governance. This is now a key pillar of retailer strategies and shareholders alike. But transparency around this is so important. And we've seen what impact it can have when bad stories come out in terms of modern slavery and carbon footprints. Next slide, please. ESG has been a key focus for fashion brands in particular. Retail brands have been taking steps to protect themselves, and one example is ASOS in 2022, which signed a 3-year partnership agreement with Anti-Slavery International. Retailers that offer low prices and align with ESG are proving really popular, and H&M has demonstrated a comprehensive ESG approach with circular initiatives and a majority stake that it's taken in Selfie's resale platform. It's constant showcasing of sustainable materials, and it plans to entirely move to an entirely recycled or sustainably sourced materials by 2030. Next slide, please. In fact, we also heard today of one platform going to launch a crowdfunding campaign for the future, showing how actually it's really believes it can engage with that audience and create that stickiness also to its platform. ESG has been a key focus. Many consumers are participating in what is called this circular economy in an effort to reduce waste and empower their spending further when the consumer purse is being squeezed. Gen Z has been one of the main groups driving growth in what's now called the re-commerce market, with platforms such as Depop and Vinted making buying and selling secondhand easier than ever. Depop, for example, has developed curated pages that are tailored to each consumer by allowing them to select their most admired brands and trends, but also creating some of that stickiness. Next slide, please. Almost 80% of shoppers surveyed were likely to shop with a retailer that offers second-hand items as well as new. And as the awareness of ESG and the social impact of fashion continues to rise, a growing number of consumers return to the resale market. This survey shows that 83.2% of shoppers believe that retailers or brands that offer second-hand items are more sustainable. Sustainability is the second most important driver for shopping second-hand apparel in the UK. Next slide, please. This shows the percentage of UK shoppers who have purchased resale items across different sectors, and re-commerce, whilst most prominent in clothing, is also rising in other sectors. Fast fashion is now a well-known term, but awareness is also growing in areas such as technology. And for example, there's rising concerns about the environmental impact of disposable vapes and the throwaway culture for small electrical items such as cable and USB sticks. In response, Superdrug recently announced plans to stop selling single-use vapes, and Electronic Specialist Carriers is also taking meaningful actions in its space by offering a service to repair, refurbish and recycle tech items. Next slide. So to close, Christmas did not give much cheer for discretionary spend, but there were some pockets of good sales. The challenge is that with technology advancement, to remain competitive, retailers need to continue to invest, whether it's to drive efficiencies or to ensure that they get their right product in the right place at the right time. Retailers, particularly in discretionary spend categories, rely on that last calendar quarter to boost profits and cash flow for that investment. And there is going to be many that will continue to make those investments, but there are those that further run the risk of losing customer share. There will undoubtedly be winners, but given that this gap is expected to widen by those that are better positioned, these winners, I believe, are going to stand out more over the short to medium term. And we may see some retailers falling away or being absorbed further by those stronger brands and retailers. I'm going to pass over to Dean now, who's going to give us an economic update.
Hello, good morning, everybody. So what I thought I'd do for the next, just over the next 10 minutes, give you a brief overview of how we're expecting the UK economy to fare in the next 12 months or so. I want to focus on four key areas. Obviously, I want to touch on the growth outlook, inflation, which is clearly key. I want to touch a little bit on the outlook for household incomes and more broadly the labour market. And then finally, just end on thinking about how the Bank of England will adapt policy this year and what that means for the interest rate environment. Now, starting with the growth backdrop, Sophie's already mentioned that the UK economy has essentially been stagnating for quite some time now. And our view is that at least for the next couple of quarters, this trend is likely to continue. And why is that? Well, if we think about the reasons for why economic activity has been relatively sluggish, it's this backdrop of high interest rates and still high but falling inflation. And that's still likely to be with us for at least the first half of this year. I get a lot of questions around, is the UK going to have a recession? Well, possibly, maybe likely. And the reason for that is that when an economy is essentially growing at 0%, it's not very difficult to fall below that 0% number. And if you get 2 quarters back to back of minus 0.1 and minus 0.1 growth, for example, the headlines will be screaming recession. But, let's be clear, that's not a recession. That's just noise in an otherwise sideways trend. So I wouldn't place too much weight on fears that of a deep recession hitting the UK economy. What we're likely to experience, at least in the near term, is more of the same of what we've had through most of 2023. Now, as we move later into the year, things probably do get a bit better. We're expecting growth can pick up in the second half of this year. And there's a couple of reasons for that. The first being that household income growth will start to improve, and this will be down to falling inflation, a point I'll come on to in a moment, and also still resilient labour markets. And another factor that will help the UK economy in the second half of this year, as well as the outlook for interest rates, which again, as I said, I'll come on to. So what about inflation? Let's move to point 2. Now, look, last year we ended in the sort of 3 to 4% range, which is pretty much what economists like myself were expecting at the start of last year. So there hasn't really been any large surprises in the inflation backdrop. Looking ahead, I would expect that inflation can continue to fall quite sharply in the early months of this year, but we're probably looking at a situation where inflation stabilises around the kind of 2% range by the end of this year, and certainly within that kind of 1 to 3% bracket that the Bank of England are targeting. There is quite a good chance, actually, that headline inflation is actually below the Bank of England's target by as soon as May. And the reason for that is, just look what's happening to the Ofgem price cap. Recent reports suggest that this could fall by around 20% in April. And if that was the case, that would shave 1 percentage point off of the rate of inflation on its own. So, you can easily see a situation where inflation dips below target. But, I wouldn't place too much weight on that. That's just noise. What the most likely outcome is that we stabilise within that kind of 2-ish% range. But it isn't just about energy prices. Energy prices have been responsible for a lot of the sharp fall in inflation. We are seeing lower inflationary trends in food prices, which has also helped. And where we are actually seeing disinflationary trends is within consumer goods, especially core consumer goods. And we don't expect that that trend's going to change anytime soon. So putting all that together, that kind of gets us to this lower inflation environment. Now, core inflation, which is another focus for central banks, will take a little bit longer to get to fall. And the reason for that is that, a lot of core inflation is driven by services. Services inflation tends to be driven by wages, as well as, quite strong demand, as we've already heard from Sophie. The demand for services has been relatively resilient, and that's likely to continue. But nevertheless, I wouldn't place too much weight on the fact that it's slower to fall. It's still heading in the same direction. Now, why this matters for the economy brings me on to the third point, and that's the impact it's likely to have on household incomes this year. What we're going to see in 2024 is that inflation turns from being a headwind for the consumer into the tailwind, which, in plain English means that what pay rises we get this year throughout the whole economy will start to go a little bit further. Now, I would also just caution not to over-exaggerate the impact of falling inflation will have on the boost of real incomes. And the reason for that is that, quite frankly, what is inflation? What is that number we all read in the headlines? It's basically a made-up number that nobody pays. Okay, and what we saw as inflation was soaring is that consumers are actually quite savvy. They kind of switch purchases. We saw trading down, as Sophie has already highlighted. We see consumption switching, and other areas are prioritised. Therefore, as inflation falls back, the boost is unlikely to be the same because consumers will react in a similar way. They'll be a bit more savvy than economic models would traditionally give them credit for. But that said, look, there will be an impact, so we shouldn't underestimate. So we shouldn't discount it completely. I would just caution that it's perhaps not going to be as large as many would hope for. Now, I think another point to think about in terms of household income growth is the distribution that we're likely to see through the economy this year. Now, when I look at the forecast for wage growth or income growth across the whole economy, what we're likely to see is that the lower income end of the income distribution are likely to experience some of the highest pay rises. You just think about what's happening to the national living wage. It's set for a minimum 10% increase in April. Other areas as well, benefits will increase by 7%, pensions by 9%. So you're going to get this quite big boost to incomes at the lower end of the income distribution. And that's a good thing for the economy, other things being equal, because this is what economists call high multiplier increases. If wage growth or income growth hits the lower end of the income distribution, this money gets spent. If it hits the higher end, then most of it gets saved. So it's a pretty positive trend we're likely to see. Certainly in terms of where wage growth is going to be distributed. But it isn't just about that. It is worth highlighting that the labour market should still remain pretty resilient, and wage growth will still be relatively high to make up for past inflation. So it's still quite likely that even in the middle income distributions, we see income growth of around 4 to 5% this year, which will help support consumption. Now, I've already alluded to this, that a recovering economy and not a recessionary economy should mean that the labour market cools and doesn't turn into a labour market that's falling significantly, and especially against the backdrop of where labour supply is still likely to remain relatively tight in the UK. And this is going to matter as well for the outlook for a couple of reasons, and especially when it comes to the consumer spending angle. And that's because, look, in the first instance, it's pretty obvious that if the majority of people are in work and they've got a job and they've got an income, they're going to spend it. But also think about the secondary impact of the confidence here. Historically, we've tended to see that sharp turns in patterns of consumption or drops in consumer confidence tend to happen around big changes in expectations of unemployment. It's actually the fear of unemployment that changes behaviour rather than the event itself. And it would be my expectation that that those fears will stay relatively muted this year, because the news on the labour market is set to remain pretty okay. Now, just finally, just what does it mean for interest rates? Well, look, an economy where we've got falling inflation, stagnating growth, but gently recovering in the second half of this year, and wage pressures that are easing, point to lower interest rates. Now, interest rates are coming down this year. I think markets got a little bit ahead of themselves in terms of the expectations of when it's going to happen and how much. In my mind, I'd be thinking that we can probably be looking for the first cut from the Bank of England in May, and then they'll be relatively cautious after that, probably proceeding at a pace of 1 cut per quarter. Now, if there's any risks to that view, it's probably that they cut a little bit more, but that will come later in the year, and that would be conditional on inflation being a little bit better behaved than what we think. Now, look, economists like myself, we're going to debate the timing of the first rate cuts and how much forever and a day until it happens. But, just take a step back and think that does that really matter? Not really, because the expectation of lower interest rates is already being felt in the economy. Most of us seeing with mortgage rates are already falling, and this is a trend that should continue as we go through this year, especially because as we move through 2024, expectations will be looking into 2025, which is where we're likely to see interest rate cuts finish at around the kind of 2.5 to 3% level. So, look, in summary, growth probably going to be pretty stagnant for at least the first half of this year, but better times are ahead in the second half of this year. Inflation very much yesterday's story, and that's a good thing, and that'll be one of the factors that helps the economy recover. And in terms of the outlook for interest rates, do bear in mind, look, people like me will debate the when and how much, but the overall impact is that the 2024 will be a year where interest rates are significantly lower for the economy than what we've seen over 2023. So with that, I'll hand on to the next speaker.
Thanks, Dean. I certainly took out of that a few positive nuggets that I think we can all think will help our retail sector. Before we go into a bit of a Q&A, I am just going to touch on some of the aspects in our retail report, specifically around this Gen Z population and their behaviours and how they are thinking about consumer spend. Please do put your questions into the chat or get them ready for Laura, who will host a short Q&A in about 5 minutes once I've just gone through a couple of slides. And just to reiterate, we undertake a quarterly seasonal survey. And if you like any more details on what our survey captures, please do get in touch. But we are really trying to dive into the nuances in changing behaviour between ages, demographics and regions, and across retail categories. And today we'll highlight a few of those in specifically related to that Gen Z customer. If you can go on to the first slide. So when we look at those macro sentiment numbers of being negative, it really does hide a little bit of difference that goes on at a category level. And what we've illustrated here is the net spend intention by all consumers across different categories. And the red line is our latest Q4 of 23 number. And we've taken a year-on-year view with the blue line. So you can see across all of these categories, there's general movement in a positive direction. But outside of essentials, there isn't really a positive story. We can see in beauty and apparel, we are back almost to parity, or at least some encouraging noise towards positive intent. So you'd indicate probably from a demand perspective, we're at the bottom of a curve and we are starting to see ourselves come into more growth category kind of horizons. Holidays, you can see there, the first one outside of the essentials has seen a nice jump. I think a lot of the media talk about revenge spend on holidays, and we'll probably see that continue this year, possibly to the detriment of some of those retail categories. Now, this is all at a high level. If we just go on one slide, what we want to try and highlight is why are Gen Z thinking differently to some of the other age profiles or demographics. Now, one thing we do ask is the awareness against these categories of price increases in the last 6 months. Now, you can see on utilities and groceries, all consumers are highlighting price increases. Everyone's aware that food inflation for the last year has been high, and utilities has been a general concern on price increases. Although, as Dean said, there's positive noise, hopefully coming out on the kind of rapid fall of those energy prices. But what you can see here is between Gen Z and all consumers, there's no material difference in how people are seeing price increases. So there isn't a perception difference around price. But if we go on one slide, what we can see is a really different intention around everyday spend. So this is all retail categories, spend intention by age group. And you can see that Gen Z, which is typically 18 to 24, and even actually to 25 to 34-year-olds, they are positive going in to the next 6 months on their spend, where 40 to 50% of the UK population is in the 35 to 55, we are seeing negative sentiment. And so this really highlights, whilst at a total level, consumer sentiment is improving, but it's still negative, that Gen Z customer or the younger consumer really is highlighting that they are willing to spend in the next 6 months. If we move on one slide, we can see that this is in some way related to their confidence in their savings levels. Now, we also heard from Dean around all those impacts in terms of what inflation is impacting on the consumer spend. And this generation, or the younger cohort, is relatively insulated from some of those probably higher impacted inflationary aspects around household bills. So they do have a positive outlook and confidence in their savings levels, being able to rely on those to improve their spend. And if you move on one more slide, we can see how this then distributes in terms of their spend intention across categories. Now, again, we saw that at a macro level for all consumers, but when we look at the Gen Z difference to all consumers here, it really highlights some positive indications. Beauty, I think we referenced, is positive for all consumers and more so for Gen Z. There's a very notable difference in apparel. So whilst we often talk about the drive for experiences and that being detrimental to product purchasing, I think this generation or Gen Z category is still very familiar with shopping brands, and apparel is still very important in terms of a consumption for them. But you can see that that difference is equally shown in that leisure spend, in eating out and drinking out and leisure activities. So there is equally this consumer wanting to experience those experiences, but I think in some areas within retail, beauty and apparel, for that age category, it's quite a positive story. If you move on one slide. We also looked and dived into some of the reasons why people think that there might be an uplift in that apparel spend. And whilst we highlighted one of the key trends for this Gen Z consumer, or in total within retail, being ESG, it's really evident when asking people why they might uplift their apparel spend. So we know that products that have a more sustainable purpose do capture this audience. And equally, some of those brands can utilize that in brand equity, and brand equity often has a premium to it. So consumers really here are highlighting that they are going to purchase more sustainable products, and that there is an understanding that for some of those brands, where there is true authenticity in that narrative, that they have a brand premium, and that might actually become a more considered spend, potentially at a higher spend. Moving on a slide. And looking at this consumer, we talk a lot about how they shop in terms of channel. When we look at the reasons for using social media, purchasing is still quite a considerable amount. And you can look out at all of the stats around how consumption varies by age category. And Gen Z, on average, I think the statistic says that over half are spending +4 hours on social media a day. And if you look at this, 56% of that is to fill spare time. So this audience is receptive to brands and advertisements on these channels. And on the right, their most likely ways of hearing about new products is when they are scrolling, is when they're looking at those adverts online and the influencers they follow. And we have heard of this trend to more of those micro-influencers, so people that have less of a following than some of the big multi-million kind of influencers. And I think that is how we're seeing brands really engage with their audiences. And then finally, just looking at what that means for shopping channels, there is still a very important role for the store experience. On the left-hand side, we've got the preferred method for researching retail products. And we've got all consumers against Gen Z. The most notable difference here is we've highlighted the online purchase, browsing at 38%, but it's more the top two buckets. So 15% are researching products on social media, or on an app, 22%. So only a quarter are really researching products when they're in stores. But the purchase behavior for buying on the right-hand side is still very favorable to in-store. So we are seeing, and we are working more with retailers and brands around how do they have all of their channels seamlessly working to engage that consumer and to allow that consumer to buy where they are most comfortable. And a lot of the time that is in store. So I think that the store rollouts, or the presence of stores for retailers, is still an important consideration as to how they go to market. Next slide. I'm now going to pass over to Laura, and hopefully we've got some questions from the audience, which we will debate.
Thanks, Tom. And thank you to all of our speakers this morning. I'm going to ask a number of our colleagues that specialise in this sector to join me for this Q&A session as we finish our overview today. Just starting this Q&A session, one of the things that I do think on the back of a number of positive messages coming out this morning, which is refreshing, probably for the first time in a few years that we've had such positivity. Dean, coming to you first, there has been a question on the audience of, do you think that there is an element of vulnerability to an increase or potential decrease in some of the campaigns around the Ukraine and the Middle East, and equally, our pending election here in the UK, thoughts as to the impact that may have on what feels like actually a year of a bit more certainty?
Yeah, look, geopolitical uncertainty has been a feature of the global economy for some time now. I mean, we found that certainly when it comes to the impact on the overall economy, the channels are principally two we've got to focus on. One is energy prices. The second is the confidence aspect. The confidence aspect tends to be pretty negative at the start of any campaigns, conflicts, but that tends to fade through time, and it'd be our expectation that although we're not going to see any good news or better news in the short term, with certainly some of the conflicts that are happening globally, the chances on us seeing significant deterioration are also pretty low. So other things being equal, it's not going to be a key variable for us that would change our outlook. Look, bigger questions around energy prices, and Sophie mentioned this in her presentation earlier as well. Should there be concerns around inflation given the increased transportation costs that we're seeing? Is that something that can change the outlook? Look, it has the potential to produce a bit of noise into the overall disinflationary process, but I wouldn't expect it's a game changer. And the reason for that is that for all the focus on transportation costs, they're a very small percentage of the final price paid for any goods or service in the economy. Okay, so these things can double, and it has to have that much of an impact. I mean, look, corporate pricing behaviour could have changed. I mean, one of the things we saw in 2023 is that companies were very willing to use any excuse in order to push through a price rise, but consumers were starting to rebel against that. So again, I would expect that the odds on that happening again are quite low from this. So it doesn't have the potential to change the game, as it were, in terms of the inflation outlook. Certainly introduce some noise, but it's not something that I would I'd put at the top of my list of risks. Look, as for the UK election, look, I'm an economist. I'll just keep my economist hat on here and just say, look, I focus on one thing: what can governments influence, and that's fiscal policy. Doesn't matter who wins the election. There's no room on fiscal policy, so I'm completely indifferent.
And I suppose taking that point and a good answer, Dean, Neil, from a tax perspective, you probably do have a stronger view as to a change of government. Thoughts of the pending budget and potentially a change of government and what may happen in terms of tax, because that clearly does affect some of our audience today.
Yeah, I mean, I've got a view whether it's right or wrong. I guess it'll play out over the course of this year. I think I'll probably answer that with what would I like to see on my wish list over the next 12, 18 months. And sort of picking up on what Dean has said, I think I would like a coherent long-term plan that whichever government is in situ continues the downward curve on inflation, interest rates, enables the country to pay down its debt burden, and provides a platform for a long-term sustainable growth plan, and allows retailers to make some sensible decisions on their investment. I would like to see, as I'm sure most of the retailers on this call, a full reform of business rates. I would like to see the reinstatement of the tax-free shopping, which I think has impacted a lot of luxury retailers, certainly in Q4. I would like to see reduced regulation to facilitate better and more efficient cross-border trade. Personally, I don't think I'm going to get any of those. In terms of the election, my view is that in the unlikely event that the Conservatives scrape through, I think we will see some targeted tax cuts in the March budget, probably around inheritance tax, maybe a few more tweaks around national insurance and some of the income tax bands, but they haven't really got a huge amount of wriggle room. I think in the medium term, if they were to survive for another term, I think tax rates generally would come down. I think with Labour, if as expected they get in, I think the tax burden is going to stay higher for longer, particularly with their investment plans. And it's going to continue to be a tough environment, and there is very little wriggle room to make things happen.
And so continuing and to close off this theme, Dean was picking up on, there's the element of consumer behaviour, but there's also the element of corporate behaviour. James, can I invite you just to give some insight in terms of from businesses that perhaps are struggling because the increased unexpected hikes in shipping, as well as the overhang of stock, what are we seeing? Are we seeing people show that resilience and being able to trade through, or anything else that people should just think about, particularly from both supply chain, but also anything else in and around them from a competitor point of view?
Sorry, Laura, you froze there a little bit. Apologies. No, I think to the surprise of my fellow retail members of the BDO team, I'm also in quite an optimistic place, and it was quite encouraging to hear the stuff that Sophie, Dean, and Tom were saying. I mean, we haven't seen any major failures this Christmas, which is good. And the snapshot of the stuff that we've been working on has had a very common theme through it, that management have been working really hard with their advisors and their lenders and stakeholders to look at the stock inventory in particular. And there's been a real realism in terms of people looking at the ticket price and the margin. So there's been a proper acceptance that 2023 was a tough year and turning stock into cash at perhaps a lower margin. So what we are seeing is a lot of businesses have worked extremely hard and got themselves into a far more stable place and can probably look into 2024, albeit there are still a lot of uncertainties, with a lot more confidence. So it's been quite a positive last few months, and from what I've been seeing.
And that plays really well into another question we've had from the audience this morning. So, Tom, I'm going to get you to start and I can perhaps give my thoughts as well. So with the balance between that online, offline channel, slightly more stable, do we think that there's going to be an increase in interest from private equity and financial investment? You and I talk about this quite significantly in our day-to-day roles. Thoughts from you?
I would love it if there was. Unfortunately, in the PE space, we do know that consumer, given the backdrop of 23, hasn't been top of the agenda. And I think the constraints that physical retail has on cost base still makes private equity nervous. If labour typically is a third of a store cost and rents, whilst could be reducing, are still meaningful, it does mean that your margin in stores isn't as great, even though it's a brilliant showcase for brands. Equally, I think there is change in certainly the number of stores that certain concepts can grow to. And I think that limits how a private equity might look at a store rollout. So whereas typically a retailer may have had 50, 60, 100 stores, now actually, because of some of the way that consumers shop and go to probably more destination retail venues, it limits the number of stores that people can have, and therefore that rollout opportunity for a private equity firm probably reduces. So I'm hopeful that they might find more love in retail, but not necessarily on a retail rollout, I don't think.
I suppose adding to my thoughts, there's a couple of things. Generally, the sentiment as we've come back into the start of 2024 is more positive. Part of the negative sentiment we've had over the last couple of years from private equity has been, as Tom said, uncertainty. They've really found it quite uncomfortable that they just don't know what might happen. So a little bit more certainty, and everything that the speakers today have said, it certainly aids that. One of the things that we've seen as a big step change is probably the amount of time private equity want with a business to really understand, going to Tom's point again, how it works, and making sure that they're not going to get any shocks post-transaction. The good thing from the comments again today, though, is that there will be a bit of a shift around bank leverage. That has been one of the biggest challenges for certainly the larger end of private equity. That's been an absolute limitation to what banks would put into transactions. And fundamentally, the model works typically with leverage, so that decline in interest rate, the improvement in sentiment will mean that the banks themselves start to want to do that. And as James said, I think certainly the big high street banks, whilst having had some real challenges in portfolio back end of 22 into early 23, have seen that businesses have really dug in, gritted, and been quite resilient, which again is giving those lenders a little bit more assurance around the sector as a whole and the resilience of it. My biggest piece of advice for those looking at investment, though, is really start to get to know the audience to whom you want to take investment, because it will take time. It is about relationship. It is about understanding of the business model. And certainly we see that 2024, there is going to be a move into that, but it's not big auction processes where you've never met a private equity house and they're going to fall in love with your business model and think that it's completely risk-free. So there's a little bit more hard work to do to make that happen, but certainly something that could well be on the agenda, and we expect to see more volumes in 24. So moving back into ESG, which was one of the topics, Sophie, clearly we headlined with as part of our report. I think a great question to start this debate, and Tom, you touched on it in your slides. Do we really think that ESG is driving consumer purchase behaviour? It's spoken about a lot. I think we speak about it with just the 3 letters versus breaking it down as well, which is a common debate from our side in our strategy to the sector. Are we really seeing that it's making a huge impact at the till? Tom, do you want to start? Because of course that Gen Z lens that showed that disparity, I think perhaps plays into this question.
Yeah, so overall, I think it does make an impact, but I think it's where along the purchase funnel it does. In growing awareness, if you think of all the attributes the consumer is looking at in terms of the price and the kind of brand fit in terms of their consumer profile, I think that awareness building around brands and the authenticity that brands now try to create is where ESG does have a role. In store, on label, to see a green label versus something that isn't as green, I'm less convinced that matters, but I think higher up the purchase funnel, driving awareness and consideration, it is a factor.
Sophie, any thoughts to add to that?
Yeah, I mean, I agree with everything that Tom said, and it's a great question to challenge on that, actually, because, this discussion has been going on for some time, and it's clear that, is it really making a difference in the purchase decision? I think the added challenge that we have is when you have a cost of living crisis, price moves up the priority list in terms of when people are making those purchases. And, we've seen disruptors like Shine and Temu, who I know the person that raised the question has been asking about, and we've and that has actually driven some of that online fashion spend with their low prices as well. So is it really making a difference? I think, I'll put it down. I think there is a shift. It's probably not as much as it's spoken about, but there is a shift, and that shift will continue. I think, if you have 2 products on a par, the same, one ESG and one not, the consumer will naturally go to the ESG one. I also think the key thing is about this remaining authentic, and we have also seen the impact that it can have on brands and retailers and on their share price when they don't remain authentic, or when there is bad news. So it's all those factors playing into it, but I do believe that shift will continue. And I think the resale market, again, this re-commerce is, I spoke about it a few years ago, actually. I was speaking about how popular we envisage it to become. And I remember the gasp in the audience when we were doing these live webinars, but it is very much there, and it's very much part of the buying culture of that increasing population of the Gen Z. So all of these factors are playing into it, and retailers therefore do need to build it into their strategy and their future plans.
Yeah, and I suppose, Tom, going back to that, the specific questions that's been asked is, when you've got the Asian disruptors at a, the mass product market, how should other retailers think about adapting to that? Is it hold your nerve and wait for perhaps consumer sentiment to turn back around, as Sophie said, or is it something more dramatic that can get those consumers to continue to fill their wardrobe, if with a blend of these products as well as the mainstream?
I think on some of the essentials or the non-fashion element aspect that these brands, certainly on Temu, have, they are incredibly price driven, and the product, I think, is a little questionable in terms of its supply chain and the kind of qualities that it comes with. So I would be focusing, if I were a retailer, on product quality and all the attributes that differentiate other than price, because I think their pricing is incredible. Whether they will then stick around or the consumer will start to realize that potentially the product attributes aren't matching their requirements, we'll have to see, because these are very new early entrants into the UK.
And Tom, while I've got you on camera, another question that we've had is just this Q4, one would say, blip to the luxury sector, where the conversations we have, particularly with private equity, is that luxury is always seen to be very resilient, and an area that people can have that confidence in because of the consumer being very loyal to those brands. What are your thoughts on that sort of fall in spending, and do we think that that's something that is a move that perhaps the luxury sector is going to see more of in 2024?
I think this is one of the areas. I agree with the question that this has usually been super resilient. Ultra high net worth, however it's defined, they have disposable income and they'll spend it. The only thing I would probably point to is, I do think that holiday and experience consumption has probably trumped some of those luxury items, and that might have dented some of those. The need for some of the premium apparel and accessory brands, and we mentioned Watches of Switzerland, that possibly has had an impact. But I also think that, for some of those, like a Watches of Switzerland, that is a treat item, a one-off for individuals that do have some discretionary income that they want to be a bit more lavish with. And that middle bit has completely gone. So I think probably those two factors are at play with some of the results that we've seen for those more premium brands.
Yeah, and we've certainly seen the same, haven't we? I know James was fairly positive, but I'd say cycling is an area that we've seen less positive performance, and part of that is exactly to that point, Tom. Very significant spending into some of these brands that perhaps they've decided to not add to the collection or replace the collection in the last 12 months, which is giving a few bits of friction. But Jason, just before we close, and appreciating time, the luxury sector has to benefit from AI, digital, thoughts on that changing platform to technology, very briefly, and how people can take advantage of that. I think it also plays to our conversation over the Asian disruptors.
So specifically as it relates to the luxury sector, the margins would generally be higher, so you would like to see better investment and AI as it relates to that. I think, more broadly speaking, I think the first mover advantage as it relates to AI is less prevalent in the luxury market, with a more traditional client base and in-store purchasing. So I think that's interesting. Certain brands don't allow online purchases as it relates to luxury brands, specifically in the watch sector. So you've got premium, and then I suppose more premium, but the premium brands by and large, so your Rolex, your Pateks, your Lang & Söhnes, do not allow online purchases, so it's store-based only. And then you've got the mid brands that generally can be purchased online. So I think by and large, creating a better user experience, on wrist type perspectives is super helpful. The challenge with AI at the moment is, by and large, that first mover advantage is creating other challenges around underlying systems being able to support the best use of AI, and obviously, AI systems and the systems that support them, the less legacy is better from a security perspective, but by and large, most organizations still have a lot of legacy. So, newer organizations that are going to market, by and large, have less legacy, so more secure, and can probably take better advantage of AI.
Amazing, thank you. And I'm sure we could carry on this debate, and I know I've not got around to all of the questions as well, but conscious of time. So with that, I'm going to ask each of our panelists just to give me a very brief one sentence on final thoughts for 2024. So Jason, as you're not on mute, your thoughts, one sentence?
One sentence. I don't know. I've never done anything in one sentence. So I think we're probably going to see investment in AI and first mover advantage kind of evolving over time. So I think that's good. I think with that, we're probably going to see some those that have done the first mover advantage around AI seeing some sort of cyber risk creeping in there. It's bound to happen.
Sophie?
I hope that Neil's wish list comes true, because I would say here to all of those. But taking on board Jason's point, I think I agree we're going to see investment, and it's therefore really important. I go back to businesses choosing what not to do, because funds are tight, is even more critical, so that they can give the headspace and the funds to choosing what they need to do.
Neil?
I too hope my wish list comes through. I think this year is going to be a bit of a bumpy one. So make sure you've got your house in order so that you can focus your attention on the right things and adapt quickly to change.
Tom?
Yeah, it's going to be a difficult year. I agree with Neil. I think just competition is high. So holding your nerve, trading hard, assessing what peers are doing, and as kind of Jason, Sophie, and yourself say, investing in the right things is going to be quite important for the long term.
And Dean, finally to you.
Yeah, sure. I'll just take it from the economy perspective and would just echo some of the comments that things aren't going to feel any better in the short term. But there is possible upside later this year and into 2025. So stay optimistic.
Amazing. What a great way to end. So with optimism, we'll call our session to a close. Thank you for your time this morning. I've certainly enjoyed the content, the discussion and the debate, and we will continue to engage with you as an audience as we go through 2024. So thank you for your time, and we'll see you all soon. Bye-bye.